myself, my name is Qiaojia, or Q for the ones who don't know me. I'm the co-founder of Rosecut. Rosecut is next generation personal wealth platform. Together with me today is Robert, who is the managing partner of QVentures. Hi, Robert. Could you please introduce yourself?
Sure, Q. Hi, and thank you everyone for taking the time, and thank you for inviting. My name is Robert Walsh. I'm the managing partner at QVentures. Before QVentures, I spent 20 years working at investment banking firms and alternative investments at senior level positions. I started at Credit Suisse, then I went to Dresdner and Unicredit. About 10 years ago, I started angel investing personally. Today, I'm the managing partner of QVentures, and what we do at QVentures is we partner with family office and ultra high net worth investors to invest in UK technology companies. We have several business lines, but the one I will focus on today is our fund management arm, and particularly our SES fund. I thought this would be relevant for a couple of reasons. First, Rosecut was an investment in the fund. Secondly, at the SES/EIS investment level, there are angels who invest alongside of us. We believe SES is best invested by a fund and using the fund to create the EIS investments as their later stage. What we consider pre-seed are, just so that we're all on the same page, and this is what when I met Q initially, were founders with a product looking to set up a company. And then we see seed companies as companies that are on their way to £1 million in revenue, just to put that out. When I met Q, it was an SES investment for us. They had customers, but now they're generating revenue. One of the questions I am asked a lot, and we'll go into this today, and that's why one of the reasons Q invited me today is, why do family offices or ultra high net worth invest in venture? To be honest, primarily it is for the return. As an asset class, venture does pay. Depending on your how sophisticated you are in a sector, it is important to have a plan, which Q will go through, and how it works with the other assets. So Q, shall I turn it back over to you?
Yes, thank you for the great intro, Robert. So before we start, here's a risk warning, because Rosecut is a regulated entity. We're sharing knowledge in general about the space, but not giving specific financial advice in this case. And today's agenda, we will first talk about why we angel invest, and then we cover strategies and pros and cons of each. And then we would really want to focus on investing disciplines. And this is something that I rarely hear people mention when they come to talk about angel investing. They are very passionate about, the companies they put money into and the wonderful things the company will do, but not enough about the disciplines. And then finally, why now is a good time. I realize this is a very bold call for us to say, when everyone is a bit more panicky about the environment at the moment. But I think this is exactly where we provide value to our audiences. And then the talk will be about 45 minutes, followed by a discussion and Q&A. We want this to be as interactive as possible, so please do ask questions along the way, and we'll try to address it either during the talk or after. So first of all, let me just throw it out there. Angel investing is high passion, high risk investment. From a wealth manager's point of view, it's not an essential part of one's wealth creation journey. You can really just make good use of the liquid, public traded investment options and get to your financial freedom. There's no problem of that. But obviously, there's a lot of people here who are either passionate about angel investing and or curious about it. And this is why we are providing a talk to show you, like, these are the things to think about if you decided to go down this path. Now, so why do we do it? From a rational point of view, diversification is the first thing that comes to mind, like what Robert was talking about. If you're a family office, typically you have a lot of assets sitting around in other type of asset classes. So what is the area that does not correlate to the return of the assets you already own? Angel investing is like quite far from everything, to be honest, from real estate or from, stock market. And second is that a line directly quoted from some of you, the original word is gambling in something interesting and potentially world changing. We change it to investing just to give it a bit more balanced view. Yes, I think, you know, you can only talk so much about ETFs and public listed companies. It's kind of boring after a while. So if you want something to be part of something that's world changing and more interesting, angel investing is the way to go. And also a third motivation, support the next generation of founders. It sometimes can be non-financial reason to do that. Because you feel like you've been supported by others and now you have the means to do so, you would want to do the same. So this really depends, though, on people who have access to amazing founder community or not. So some of them are your friends, then it's easy. But there's always problems coming with that if you have a small circle of friends, we will touch on later on. But typically, we're saying for most people, it's rare for you to have direct access to CEOs and many CEOs of companies. But early investing, you know, can create that access if you start doing this for a long time. So now let's go to the second part, angel investing strategy. When we talk about strategy, it's about the overarching way of how you're going to do your angel investing, not about selecting each individual company and why a certain company would work or would not in your view. So here we listed some of the successful strategies. Myself as a wealth manager have seen. It's not a complete list, but just here for ideas. One is network builder. So this is one of a really well-known full-time angel. He was a city trader and then decided to switch into angel investing 10, 11 years ago. So what he does is that he invests on average one company per month. So for the past 10 years, he built up 100 companies. And what he provides to those companies are not necessarily guidance in the specific domain the company was in, but rather, you know, bring them into his personal network. He offers his accommodation in his property in London and San Fran for free for you to hold events, to meet people. And he does reference checks on whoever you want to take on as an angel, as an investor, and provide a DD for the hiring as well. So to me, that's a unique value add. So the pro of doing this, is he quickly built up a personal name. He's quickly seeing return. The con is obviously that's a complete career change, and not many people are prepared for that. And it's also very time consuming. He's operating like a one-man VC firm, seeing like, you know, thousands of deals every year. Second strategy we've seen is vertical specialist. You know, we can't share the names, so we say YC here. So this person comes from a traditional manufacturing for fashion background, and he built consumer brands and investing to fashion tech. So he invests along the value chain from like brands to inventory management software, from e-commerce platform to 3D fitting. So this, you know, is a similar approach used by many fintech angels because they have deep domain knowledge. The pro of doing that is that this knowledge becomes an edge in terms of your investment selection process. So you have, you know, in-depth knowledge along the value chain over time. The con, though, is concentration risk in a single sector. And this is highly correlated for your main business activity or main day job as well. The third strategy is user insights. So someone I know called Pian, he's got an eye for software. So he's really good at picking up the software that potentially has a viral effect, and he's right a lot of the times. And myself fits into this category as well. For the companies I invest in, I'm a heavy user of. That's the only criteria. So the pro of this is that it's very simple and easy to execute. The con, though, is that it's very path dependency, depending on your network, depending on your background, and also you might have a sector bias. So for me, because of that, I pretty much only own consumer companies, which, I need to make peace with this end result. And number 4 is indexing. Indexing means like you invest many individual investments that it compromise basically the whole market. So there is an angel investing network called Ventures Together. They collectively invest into companies, and they have, professionals organizing the deal flow and stuff like that. So the proud of this is you obviously have your own startup tracker of UK or UK plus Europe or whichever region, and this brings the best diversification. The con though is that because you're doing small tickets, a couple of thousand into 10, 20, 50,000, then you don't own meaningful percentage of any single company. Angel investors don't own any like big percentages anyway. It's like a couple of percent at best. And here you own 0.01% after dilution. So even if a company goes really successful, you are less likely to get meaningful return from that investment. So family offices invest in a different way from a lot of, everyday investors that we're seeing. And Robert, can you share a few words on this?
Sure. I mean, we work with a lot of family offices, and as they always say, no one family office is the same as another. I think family offices look at this from a couple different perspectives. Number one, remember most family offices were actually operators at one time. It might be this generation, the generation before. They might still have an asset that they operate. So they're actually quite valuable to startups because they understand how to build companies and what needs to go in a company after it scales. And then how to keep that ethos going because there are several generations of companies. So I think that's the important thing to remember about the family offices. And then they either, as you said, Q, is that they either diversify away from their traditional, or they're using a tool that will be part of their traditional family office. So if a family office has made money in hospitality, they might be working with ecosystems. They'll often invest, but also become a client and help the founder very much work their way through getting sales, because they do realize that revenue is very important. So that's one family office perspective. The other thing to remember with family offices is that unlike a VC, I mean, as compared to an angel, in a way, they're very similar in the sense that they don't have an exact plan. They tend to shift around a little bit depending upon what's going on in the market. They haven't sold to an investor a strategy. And also, there's different skill sets within family offices, which you'll often find if a family office, once again, has made money in hospitality, the next generation might have went to school and learned about life sciences. So they're bringing both of those abilities to the table. What we do see is that they do write large checks. So to give you an example, one of the companies that we brought, and I think it's important to say angel investing, whether it's pre-seed, seed, Series A, Series B, there are different strategies and different return profiles when you're looking at this. And I think we oftentimes group them together because it's easiest. But as you move along the spectrum of Series B to Series D, there is a challenge with access if you don't have a lot of money. But number two, you might not need as much diversity. So we think diversity at the earlier stage is more important. But getting back to the family office, what you'll often find with family offices, they like to recycle the capital that they've made from their venture investments. So we had one deal that we did 4 years ago. It was called Go and Store. It was a £5 million valuation. They had about 200,000 or 300,000 pounds. They had about 400,000 pounds worth of revenue. We had 3 family offices go into that. And then 3 years later, it was sold for 100 million pounds, which is a great return. And those family offices have now recycled that money. Now, if we break down the 2 family offices that went into that, one is a Middle Eastern investor who's 5th generation family office, who are quite familiar with taking these types of bets. And they looked at Go and Store and said, the founders were very good. And they bought into the proposition that more people would be communicating online. The other family office that went into it is called more of an ultra high net worth individual who has a very good job in the city that made the same bet for slightly different reasons. It was more of a diversification play. So I think as far as the family office perspectives go, is that they are always looking at investments, but I think it can be frustrating because since they don't have a plan, if you compare them to my pre-seed fund is you can go to the website, you can see what the plan is, and you can determine if you want to take that risk or not. But I do think the other thing that family offices will continuously do is that, unlike a VC, they can support 5, 6, 7, 8 rounds, so they can follow their money and continue to give that support to the founder. They're less focused on timing. And that's really kind of where they bring a lot of value. And then slowly, if you invest in a company at 3 million, and then it becomes worth 300 million, you move it into a different bucket. It's almost like a growth stage or a PE investment at that stage. So I think family also are very flexible with that. But I think the other thing I would just mention before I take up too much time is that their family office money, like the pension money in the US, it's a long duration investment. So they're able to take that long duration investment, such as anytime you're an angel, you should have that under your mind as well. I hope that was helpful. Q, do you have any questions?
Yes, that's a great point. Actually, we were going to cover in terms of the long-term support in the discipline part. So just worth mentioning as a last point about the strategy, a lot of people think, okay, angel investing in UK has like SEIS and EIS, where you get 50%, 30% rebate on your income and then capital gain tax and stuff like that. I think it's worth mentioning tax efficiency alone is not good enough a strategy, because whatever tax rebate you get, it's always less than the money that you investing. And if you are making wrong investment, you are losing less instead of making money. So tax efficiency is not the right way to go. And if you just care about the tax, then you're really not having enough interest or passion to do the hands-on sourcing and DD of those investments. And you need to formulate a view of where you want to put your money as well. Now, we're not saying you shouldn't go into angel investing at all. If you don't want to do hands-on sourcing and DD, there are ways to do it, such as giving money to the professionals who can build your angel, portfolio. But worth mentioning, tax efficiency is not the only reason you do that. Second part, about disciplines. And this is, as I mentioned, we want to cover this because this has nothing to do with whether a company is going to fly or not, but this is a really important thing for this to making angel investing work. Number one mistakes I see people doing in angel investing is lack of plan and doing, bits and bobs and dipping in and out. Absolutely no idea, what they want this to do. So the recommendation here is that it's a real numbers game. No matter how much you fall in love with a particular business or particular founder, the chances are this company is going to fail. The success rate for early stage startups is below 0.3% based on index ventures figure from business plan to exit, or a couple % from pre-seed to exit. Either way you look at it, the chances are it's going to fail. So be prepared to build up a portfolio of 100 or at least 50 through economic cycles. That means not just investing in the booming years. I have a negative example for you here. Someone I know, bet heavily into 3 sectors: biotech, fintech, and crypto between 2016 and 2021. So these are bull market years. And by now, those verticals are either evaporated or heavily discounted. So think about, whether you don't have to put away the whole fund for 100 investment from day one, but you need to prepare to allocate cash to this every year all the time along. Second is standardize your tickets. People do 2K here, 10K there, 20K there, wherever. But we say, okay, make it say 10K or 20K, or if you're really in love with a certain company or think the price is good, double that. So if your standard ticket is 20K, make 40K for that one. So you can actually calculate your return after rounds of valuations and different type of dilutions.
Yeah, Q, I would add just that, because some of them, and it's actually quite important, because number one, your losses will come earlier, but also if you standardize your tickets, you'll manage your own expectations, and you'll be able to make those extra bets. I think a lot of people do make that mistake of not standardizing their tickets.
Yeah, exactly. So I think, it's usually their ticket is round valuation driven. So they target to hold a certain percentage, or it's based on other rationales. But from an investor point of view, the number one thing you care about is what is your return of doing this over time, right? Like you actually, if you can't come to that figure because of the complexity in the calculation, then that lost most point of that. And the third point is a hold super long term. Let the winner run and plan to follow. So what we see a lot is that some angel investors, they go in at seed stage and they would come out at Series B. And although that might be your investment thesis, there's no right around to that. I would like to point out one thing. Through the lifetime of a company, 95% of the value is created post-IPO. So between seed to IPO, that's 5%. VCs and PEs, they need to exit due to their business model, because that's how they agreed on the terms with their LPs. But you as an angel investor, you don't. You can hold winners forever, technically. And this will really have a multiplier effect on your return, because the seed stage to Series B is actually the riskiest earlier years of a company's life. So, one of the VCs I know, who is the godfather of the VC in Asia, Benson Tan, they went into Alibaba in the first institutional round. He wrote a check of a couple million, together with Goldman Sachs, a couple million. 2 years later, Goldman Sachs went out. They bought the Goldman Sachs piece at probably 2x or 3x. But you know what? They invested $20 million along 3-4 rounds and end up $2 billion as the gain. So this is what Robert was talking about. And family offices are willing to follow on, and you can think about that as a strategy. If you don't have the cash to play that game, it's fine, but at least hold the positions of your winners. Number 4 is build feedback loop. This is simple, but not many people do it. Always write down what the thesis of each investment at the time of investing, and you track the progress and outcome. You review on an annual basis. You refine your thesis over time. So, Robert, do you have a few case studies?
Yeah, we can have some case studies, but I think on the feedback loop, I think because not only there's several things moving in venture capital, and one is the founders, but it's also the technology. So, the cloud has been helping us quite a lot. If you look 15 years ago, there was when the iPhone came out. So it is good to take a step back and review what your strategy is and if it should change, even if it's very good. So, Q, you had a question for me?
No, so I think that, do you have any sort of a particular example of a family office or ultra high investor you have, like sticking to a specific discipline?
What I've seen more than a discipline, because we don't get too deep into the disciplines they're doing. They tend to follow themes that they feel they understand. So what you'll have is you'll have them trying to create a diversification within their own family office. But what I think catches up with some of them, because as the example you just gave, is that if they're very successful in one of their investments, because they can follow, we've seen one ultra high net worth take an investment of 2 million and then lend to the company as well, probably in aggregate turn that into about 50 million. Now that is probably now half of their net worth or their family office. So I think it's really kind of not only should you ride your winners, but also see if there's other things you can do with them, such as lending. And there are other opportunities, because number one, and this, we haven't talked about this, but when you're an angel investor and you're helping somebody build their company in the beginning, they remember you. They do, because that money is what they need to get their dream. And so they will give you more opportunities than you think down the road. Even if you're not a big ticket, even if you only put 10 or 20 in the beginning, if there's a lending or another way to make money, they would rather have pay it to you than to other people. We've continuously seen this, and any value you do give to an entrepreneur in the early days, because most entrepreneurs in the early days are short-staffed. So they do want to get the advice and any help they can. They do remember it. And so I think that's a very important factor there. We also see with family offices, they do like to club together. So oftentimes if you talk to one, you're actually talking to 3 to 5. And more than likely, they're going to try and become your client in one form or another. We've got another, in our broker business, which is not on the pre-seed side, which is more the later stage. We raised 12 million pounds for one of the companies out there. And
Cloud&C you're talking about.
Yes, Cloud&C. So I have 2 businesses at QVentures. One is, working on the fund management, as we talked about. The reason we did the pre-seed fund is we found that it's easier for the founder to get a professional like ourselves, especially from the family office, because they do quite deep due diligence, and we take that on. But on the other part of my business is that we do work with early stage companies and family offices to raise the money. So Cloud&C raised 6 or 8 million pounds from a VC out there called Atomico, and our investors put another 12 million pounds in there. And so if you think of the family offices just in general, that means they're writing a ticket 50% larger than the largest VC in the UK or maybe in Europe. So I do think they are going to transform the market here, and also ultra high net worth individuals. I do believe it should be part of your portfolio, unlike Q's earlier comment, but I do believe it should be more than 5 to 10% initially of your portfolio. But what you'll see is that they also give a lot of advice. They're also able to make the right connections for B2B sales, right? So we have one investor that owns about 3% of Cloud&C, and he speaks with the founder every 2 months. Now, that's more kind of from a mentoring perspective, which is something you can do as well. I think a lot of angels forget, or family offices forget, if you're able to write large checks like 10, 20, 30,000 pounds, you have a lot to give to a new founder. And I think that's what people should look at. But as far as family offices, they tend to have different strategies, which is very awkward and very annoying. And I know I'm not answering the question very well, but most of them will want to be able to touch your business in one form or another based on their past. And that's why it's very difficult to figure out what they'll be doing. But they very much, like an angel, should think about, can I follow and can I continue to add value either economically or just with your network?
Yeah, so worth mentioning, there is one example of the discipline that worked against me. The example of the network builder, JY, he was a very good friend, over the 10 years. And but when it comes to investing, he did not want to invest into Rosecut because his thesis is only investing to founders in their 20s. Before they get polluted by the corporate training. So even though on a personal level, that's deeply hurtful, but I have a lot of respect towards people who really, follows their discipline, because founders in their 20s have the highest fail rate, but also have potentially the max chance of the out-box thinking and create something huge. There you go. And last part, why now is a good time if you have the cash? Obviously, some of you here are founders that I'm aware. So you feel like this is a time where everyone is scrapping for funding, and there is a liquidity squeeze in the market. You see, investors of all shapes and size having this problem. I know someone who has technically $1 billion in net worth, struggling to make £1 million capital call from a VC that he signed up to. But that also means that you have far less competition if you have the cash to go into the market now. Second is obviously together come with this liquidity squeeze in the market. You have much lower valuation compared with the peak, let's say 2021. So it's difficult to know private companies' valuations, but if a crowdfunding platform provides any data, you can see, for example, big name fintech companies' valuation went from GBP 650 million to 2 to 5 million. So that's more than 65% discount. Also in the US, the sort of street discount on Series C, D companies is about 50%. So I know someone who's doing secondary, picking up shares from those companies. And angel investing, the founders' expectations are now, let's say, more realistic. And this is where, you can pay the same amount of cash for a more meaningful stake in the company. So it doesn't matter what kind of investing you do, buy cheap or buy low is always a good thing. And when others are fearful, you go greedy, and this is called contrarian strategy. We think it's a time to, this would be the really good time for this to work. And third part is right now there's a lot of founders looking to stretch the cash into profitability. So that means they will raise less rounds in the future. Every round on average dilutes you for 20 to 30%, just like to the founders. So that means that if they reach break even, there is less incentives or less pressure to raise every couple of years. So that means much less dilution in the future for you, which is great. And number 4 is an interesting point. In my network, I see many companies go into liquidation, and many people are sort of sitting on the side and not thinking about starting a company now. So if you go to the market now, you're going to get really committed founders, relatively speaking, and less people who think startup is the trendy thing to do. And also, by comparison, every economic cycle between 5 to 10 years, recession is only like, on average 9 to 18 months out of that. So that's let's say, 10, 20% of the time. But 50% of the Fortune 500 companies were created in this very small percentage of time and make it big. So here is the list of those companies, from more than 100 years ago. Standard Oil started during the final year of the Civil War to, FedEx in the 70s started in the middle of the oil crisis. I just can't imagine how that worked, but it worked apparently. And then to the most recent examples of Twilio, it started in March 2008, and then everyone knows there was a 1-year drought after that in terms of funding during global financial crisis, and Airbnb started right in the middle of the financial crisis. So these are the examples of the companies that really took off and have the resilient founders to make it work from the recession onwards. Robert, you were going to say something.
Yeah, no, Q. What I was going to say is, if you go back to the slide before that, I think it's important to note a couple of things. One is that, founders are more resilient. But I think it's important that people are now hiring to get an exit or to get revenue, as opposed to thinking that there's another round in 6 or 9 months. So I do think companies are more realistic now, and that's very good for them. And they're not hiring for, I'm going to do a, £100 million round in 2 years. Let me hire 6 accountants. They're hiring as and when they need. So I do think the companies are very good. But I also think that venture has always, even in the bull markets, has paid well, over 10, 12%. So it is a very good time to enter. But more to your point, if you enter this year, keep going. Get some good years and get some bad years. At the end of the day, it will, especially here in the UK, if you overlay the tax benefits, it will continue to help. What we've seen at the pre-seed level is we've during the bull market last year, we actually didn't put really much money to work between February to August because founders thought they could get cash elsewhere. And we haven't really changed our strategy. We've always been quite fair on price. We've never overpaid. And then we saw founders say, you know what, I want to get on with this. And we've had quite a few very good companies come through in the last cohort of companies. So I do think now is a very good time. Although if you have your strategy, as you said, you won't invest into the over too high valuation companies. So by putting all the tools you had at the earlier part, you can do very well. But I also think if you're looking at companies today, the value is there as long as they have enough runway to get to the next KPIs, because people are just being more realistic with what they think they can do. We don't see these absurd business plans anymore. For pie in the sky ideas. Luckily, it's always not so nice to do. So I do think, like you said, it is a good time, but it's also a matter of you should determine, do you want to do pre-seed? Do you want to do seed? Do you want to do Series A? And then how do you get access to it?
Yeah, that's great. These are all great points, Robert. So, you don't see obscure business plans anymore because those people thinking, oh, I'm actually not really behind this idea or something. So it's probably a good exercise, after today's presentation, that you are thinking, I'm still committed to this. I would like to formulate my strategy and my principles, and then you actually listed it down. What are your beliefs? What are your approaches? How does that fit into your or wealth and income sort of cash flow basis? So, obviously Rosecut provides the cash flow projection for your future, but this actually requires a bit more work than just, we say, because we are focusing on creating technically a business plan for a specific asset class. Or you think, okay, this is, not for me, and I think this is too much work. I want someone else to do this work for me. Then you can just say, I don't want to worry about angel investing. I will just put the money into the financial markets. That's also fine. Or you say, I would want to build a portfolio, then, QVentures pre-seed fund is the way to go. So all of this is to say, you don't have to go into angel investing, but if you do, please do it in a more organized and informed way. And this is, what we want to deliver with this talk. And to finishing it off, there's a plug to say that Rosecut is raising our angel round to reach break even in the next 6 to 12 months. Exactly, following what we were talking about today. If you think what we have covered today is useful and make you feel confident that, we could continue delivering value to you, please register through the link that my colleague is going to share now in the chat for the angel round. And that's how much we're going to talk about today. We finished actually slightly ahead of the time, which is rare. So now we have Q&A and discussions, and you don't have to ask a question. If you have a view, a comment that you would like to share in the chat, or you can simply unmute yourself and ask that question. It will be great too. So Robert, I actually have one more question for you, right? What is the big mistake you see people making, either from professional investor background or just, investors in your community?
Well, I think, and even when I first started angel investing 10 years ago, I think the mistake is it's easy to get wrapped up in the story. And so you need to be just very careful to do your due diligence and make sure that there's enough money in the person's raising enough money in the round. I think that's what really kind of to make sure they hit their KPIs. And then just getting wrapped up. I mean, I remember some of my first meetings as an angel. I laugh at them now, but I got wrapped up in a couple of without a plan. Of course, I had no plan. I was working in the city. I was quite busy. I had no plan, and some of the meetings just kind of like life sciences. I invested in a life science company which was going to cure malaria. I wish it did. It didn't.
The tax benefits helped me not lose a lot of money, but I still lost money. And so I think that's one of the big mistakes people make. Or people think that there is a liquidity event coming down the line, and they don't realize that this is an illiquid part of your portfolio, and that's the way they should it. And the third thing I think is people go in with the best of intentions, and then they don't support the company the way they should. And they could actually help. They don't realize how much they could actually help the company in achieving their goals. I think a lot of angels could, even making 1 or 2 introductions to the right people, is the right way. So, but it's really about making sure you understand the risk you're taking and why you're taking that risk.
Great. Thanks for sharing that. So I think that now we have a question from Alex. What are the most important questions to ask when doing your DD? I guess, I will just answer first before Robert gives his version of answer. For me, I think this is depending on the type of strategy you employ. So, for example, if you are a vertical specialist, then you really ask in-depth questions. You might actually have a view on whether the business model is viable or not. If you are the one who, choose to back great founders, then you ask a lot of questions around the founder's motivation and characteristics. And so you come to a conclusion whether you think this founder is going to stick through the hardest times. And then, if you are doing indexing, actually that matters less. What is more important is actually to figure out what sector is each individual company fits in, and then you try to cover the market as much as possible. So, for example, if you are from a specific sector, let's say, enterprise software, then you actually have to limit how many enterprise software deals you do, let's say 10, 20%, and try to do other type of try to do investment in other verticals. So that's my version. And what Robert what would you say?
Yeah, I mean, we have our DD listing, and rather than our list of DD questions, but I think what less, like any investment you make, you should have your due diligence. But I think one thing you should definitely drill in on an annual investment is advisors. What are they getting paid? How much are they committed? Are there KPIs alongside those? And or are they just somebody getting 3% of the company? Oftentimes the founder will give up too much of their company early days because an advisor will promise something, or make sure that there's a way to do reverse vesting or something on the shares if the advisor leaves or something like that. I think that's one thing. I mean, any investment you make, there's a pretty standard strategy. Make sure you understand it. Make sure there's enough. The other thing is make sure they have enough runway. That's one of the important things, to make sure that they're able to execute and they know what they're going to do with the money. The third thing I would say, which bounces around a lot, which we don't do as much, but there's this very vague marketing budget for a lot of people. And you should drill down on what are they going to spend on the marketing budget and when does the return come back from the marketing budget. We'll often see at the pre-seed side, yeah, I'm going to raise 400, I'm going to put 125 into marketing. For what? And it's almost as though it's not that you shouldn't invest if they don't. It's just working with the founder for them to vet out their idea. And also, what I would say is also in doing the due diligence for yourself is it's a rocky process. The founder is generally very tired and is spinning a lot of plates. So don't hold them. Like we get this with a lot of private equity guys that come to us. They say, "Well, I thought it'd be more professional." It's like, well, it's a 10 million pound company or a 3 million pound company. It's not a 300 million pound company that you're dealing with on your day to day. So it is very important to make sure that you're looking at a pre-seed company differently than a Series D company. Or as Qiaojia said, are you spraying and praying, which there's nothing wrong with that, or are you doing 2 investments? So that's kind of what you need to work out before you start asking your DD questions. We run, but the other thing is, as a strategy, we run the DD on everybody, on the founders, on the plan, and everything else. But we're professionals, so we have that time.
Yeah, this is really important. Actually, people underestimate typically how much time angel investing would take because sourcing, for example, is quite a lot of work as well. You can't just invest into every company you met. Typical case like 1 out of 10 or 1 out of 20. So how do you get that, a quality 20 to start with, and having meetings with them or having some way of, assessing their business viability and pay for the contribution and signing documents, tracking, all that kind of stuff. This is before you do any sort of value add as an investor.
To put it in perspective, I have 2 people that are dedicated to marketing and events. That's away from investment professionals to make sure the deal flow comes to us.
Yeah, that's a typical setup, full-time deal sourcing. And Kevin asked a question. What is the success criteria of an exit, or what are the success criteria for exit?
Is that from? It's an interesting question. I mean, a success for it really matters how your portfolio is going, right? But I'm wondering if that question is more if a founder has said they've had a successful exit, because we see a lot of people who come to us that say, "I've had a successful exit," and you have to ask the question. I've had people that, but anybody who's built a company and has sold it for a certain amount of money, to me, is some success. It's just a matter of what are they doing in comparison. We aim, like one of the companies, we had a 15 times return. We're trying to do a 3 to 5 times return for the companies. Our average enterprise value is about 2 million. So in our opinion, if we can get these companies sold for over 30 million pounds, we think that's a good exit. But it's a matter of how many do you have, right? If you're doing the other strategy of going to 100, you need, a company to do 100x. So that's 200 million.
Yeah, actually, that's a very interesting question. I would say that, from a pure financial point of view, you would compare the opportunity cost of your money. So starting point is that if you put the money into the global stock market and just track it on a long-term basis, that's 7% a year. If you put it into the bank as a saving, used to be 0%, 1%, now it's 3, 4, 5%. So angel investing should make more than either of these two, or both of them, ideally. And there's not enough data on people's angel investing return. There's no solid data, but the sort of guess is that as a sort of a investment category, overall it's loss making. So how do you not to lose money on this and see meaningful returns? That's why we suggest you follow some sort of strategies and disciplines. Another benchmark you can consider is that private equity investing managed by professionals at later stage companies, which are arguably less risky than angel investment, their median return is 15% after fees. So you need to be at 15% as well. By the sound of it, Robert's fund, target is way above that, but that's how professionals run their money. So this is my point of you don't have to do angel investing, but if you really want to do it, consider do it properly, so it brings you more return than the lower hanging fruit, which is investing to the public market. Next question from Alastair is that how can startups maximize their value for investors beyond just financial return? That's a great question. Robert, you want to go first?
I'm not sure. I mean, it matters what their investors. I mean, if people are just going in for a financial return, that's something. And this is where the broad stroke of angel investing. The relationship I have with Q is a financial relationship, right? I've invested because I expect it, right? And she doesn't expect anything else. And let's be fair, I'm here because I'm expecting, Rosecut to do very well. So I do think that's very difficult. But there are different startups where you can get your LPs together, and we do get our LPs together in the fund, and that's how we bring added value there. But I don't know. Do you know what I mean? I don't know, Q, if there's things you do for your investors that are beyond financial return.
That's actually, I really appreciate your honest answer, Robert. And I think I would agree if, from an investor point of view, I'm putting my money to work, I would like to see return. So the best thing you could do for the investors who's given you money to back your business is try your hardest at the business. And don't give up at the first sign of, stress or trouble. And obviously, it's up to the investors to make up their mind whether you are made for that. But for you as a founder, I think this is kind of the commitment to the capital you have received from the investors. And the second thing I would say is that transparency is probably really big for me. So it's fine if my investment is going to fail, but please tell me why it failed. And please tell me the real reason in your best possible way. So, I think transparency doesn't mean frequency of reporting. I know some startups do very frequent reporting and investors begs them to take them off the subscription list. But transparency means you're authentic and you're genuine and you share, enough information and data with your investors so they can have the option, not the obligation, the option to see what's really going on in your business and option to step forward to help you as well. So that would be.
Sorry, Q, I was thinking after you started that, I would say frequency is, a quarterly or a monthly report, not with a lot of stuff. You want to make the journey of their investment to be, like Q said, if you lose money, you'll lose money. You don't want to find out on a Tuesday that you're losing money on Wednesday. There should be a journey, whether good or bad. Oftentimes, a lot of founders will only update their cap table on good news. And then they wait for good news. And then they wait for good news. Even looking back at the financial crisis in 98, 99, when the high yield market, when I was working in that, my investors were just like, I have people I have to answer to. And your investors are thinking, if you say you're going to exit in 2 years, they might be taking that money and buying a car or buying a house for their daughter or something like that. So giving them that journey of fairness is just the right way to go. And don't just do good news, because that is just the worst, because you lose your confidence.
Great, thank you for adding that, Robert. And Attila, if I'm pronouncing the name right, up to what stage are angel investing, pre-seed, seed, Series A, etc.?
I would say, we see more at pre-seed and seed, just because it's more available. Once you're getting to Series A and later, it's more difficult because your 20 or 30 grand check doesn't mean as much. And people start cleaning their cap tables.
Yeah, I would agree. So I would say if you really want to play this game, going as early as possible, ideally at the first round of funding for the company, you no doubtfully will be diluted the most. But this is where you're going at the lowest possible valuation. It's all relative, right? That's the first round of valuation of the company. So I know professional angels who only does first round of funding as one of their principles. They don't do follow-on funding, no matter how great the company is. That is not based on whether the company is going to have a great exit. It's not a judgment call on that, but in terms of their dilution or sort of leverage target. So that's that. I would say nowadays, there is crowdfunding platform where you get a whole mix of companies, from the very first fundraise to potentially Series B, C, D, that is pretty late stage. So the late stage funding is typically part of a bigger round, a VC or some sort of strategic, and they come to crowd platform to have a top up or a bridging between different rounds and things like that. So you can have access to later stage companies, but that's not technically angel investing. Angel by definition is you go in early. It's crowdfunding, and there's nothing wrong with it. I do a lot of it actually, and this is how I pick up sort of later than stage companies for tax benefit, and where I'm a heavy user of the company. Angel investing, I think for today's discussion, we would say pre-seed, seed. By the way, there's nothing wrong to do the second round or third round. Doing the very first round only doesn't have to be your principal or your thesis. Great. I think actually that's all the questions we have in the chat. Unless someone who wants to unmute themselves and voice a question or comment, we're finishing on the dot today. Amazing. In that context, what would be the max of a month? I think that's up to you. Some angels start with a couple of thousand, and then you have to be part of a bigger group like the QVentures together. They actually have a strict selection criteria, so that's that. And I have angels invested into Rosecut up to 150K. So that's the size is more to do with a percentage of your overall net worth, how much of a percentage you allocate to angel investing. And so, for example, if you have 100 million as a family office and you want to do 10% into angel investing, that's 10 million, and you want to do at least 50 ticket, and that means 200K per ticket if you standardize it. So that's how you run that calculation. And that's a quick answer. And thank you guys for attending today's webinar. I hope it's useful.
Thank you so much, Q.
Bye.